Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will check out the U.S. dollar and the major equity markets. Ed Steer, founder of EdSteerGoldAndSilver.com, tells us why he's bullish on silver. He also talks about his 17-year battle to stop the manipulation of gold and silver prices. Car expert Wolf Richter from WolfStreet.com talks about Carmageddon, the possible economic burden of subprime auto loans. He also debates the merits of buying new or used wheels. Plus, at the end of the show, we'll have company showcase updates with American Manganese President Larry Ray and Avon Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
A pleasure, Jim.
The U.S. Fed raised rates earlier in the week. What kind of an impact did that have, especially on the U.S. dollar?
Well, this clearly was one of the most forecast events of this calendar quarter. And the move by the Fed was definitely in the cards. There's no question about that. But we did get the inevitable bounce in the dollar. It had one of its better moves in the last week or so. They'd been pounded down at the beginning of the week just to marginally lower lowest levels for the year. Made a very, very good move back. And from a technical perspective, this becomes a pretty interesting week in itself, because we've been bound by about in the last 4 weeks in a fairly tight range, 96 and a quarter, let's call it, to 97 and a half. And on Thursday into the close, we tested the top end of that range and then backed off. Our work is such that we've been looking for a basing period in here, and a reversal on a close back through 97 would suggest that the base is in place and that we could then look for a nice move on the upside. But having been as oversold as it was 4 weeks ago and consolidated, it is absolutely critical from a technical perspective that it does make this turn. So we're going to be looking at that 96 and a quarter as a real catalyst point on the downside, and 97 and a half on the upper side of this. So for us, it's pretty important as we move through this next few weeks and the implications it's going to have for probably most of the summer.
Canadian oil is sold in U.S. dollars. How does that impact the Canadian oil industry?
Well, the Canadian dollar has, even though we've had lower oil prices, we're down now into the $44 range. It's been stair-stepping down, as we talked about here the last couple of weeks. This markdown in the oil price, surprisingly, Canadian dollar has been holding up pretty well. We've had a bit of a rally over in the grains. The wheat market had one of its best moves here in the last couple of months, starting to show some life over there. So where you would normally have expected Canadian to be down with the oil market, we've had just the opposite, a pretty good week on the upside. And I was looking at the Commitment of Traders numbers at the end of the week. We had very, very extended bearish positions on by the speculators about 4 weeks ago as the dollar was finding its bottom. And oddly enough, through this really good rally that we've had, those positions are not being taken off. So there's still, I would think, as far as the dollar is concerned, some further action to go on the upside. This would be just sort of the inverse of what we saw in the silver market this time last year, when we had very high bullish speculative positions on, and we had to have a pretty good clean out on the downside. So for the Canadian, I would think that there's at least another cent or two left here on the upside before we're even looking at a temporary high.
One of the big deals pulled off during the week, Amazon buys Whole Foods for just under $14 billion. What kind of a signal is that?
So you got a big 3% day on Amazon on the upside. But for the other retailers in the food area, the Loblaws, the Walmarts, the Costcos, it was a pretty bad day out there. And, you know, we think back to what it was like when Amazon went after the booksellers, and as it, you know, there's no guarantee that they will do as well here in the food area, but it's going to be pretty tough competition for the rest of them. You know, from the fact that the distribution network that's now available to Amazon, they went from a minimal number of cold storage lockers to now an extra 200. So they've this helps out their whole distribution network, not just the advance into the or expansion in the food side of it, the things here. So we had technical signs that Amazon was overbought the better part of 3 weeks ago. Had a hard break. It's trying to recover back to the high. We'll see how this goes, because there's been a lot of takeovers in sectors over the last half a dozen years where the acquirer has basically topped out in short order afterwards. So let's see what happens with Amazon. I think that $100 or that $1,000 level that it's sitting at right now may still become a pretty significant overhead.
Well, it's easy for you to get the numbers mixed up because we were just talking about Whole Foods off the air where, you know, it's not unusual to see a loaf of bread for $100 because it's just been flown in from France.
Yeah. Well, yeah, Whole Foods or Whole Paycheck, one or the other.
Ross, thank you so much for being on the show.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Coming up, Ed Shear, next on This Week in Money.
Always consult your investment professional before making any investment decision.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ed Steer. He's the founder of edsteergoldandsilver.com. He's a director of GATA, the Gold Antitrust Action Committee, also known as GATA. He's speaking to us from Edmonton. Ed, welcome to This Week in Money.
Good morning to all you and all your listeners.
Ed, to start with, are you more bullish on gold or silver?
I'm always more bullish on silver, and mainly the reason is the setup on the COMEX futures market is far more bullish for silver at the moment than it is for gold.
Is the gold-silver ratio a good indicator for silver?
Well, no, it's the prices of all precious metals are so distorted you really can't use that as a comparison, because if you look at the way silver and gold come out of the ground, it's a ratio of, about 9 ounces to 1 ounce, and the gold-silver ratio right now is around 73. So it's about 8 times what it should be, based on just the way it's mined and the way it's used. So 8 times whatever the price is today, $16 an ounce? Well, I can't do the math, but it's over 120 US. So there's a huge disparity between what the price of silver should be and what it's actually at, and that's, like I said, as Ted Butler said, over the last 30 years, it's all because of COMEX positioning and the 8 or less traders who are sitting on the price of the metal right now.
Right now, is silver being treated like an industrial metal or a precious metal?
Well, it's got facets of both. It's one of the very few commodities out there. As a matter of fact, I can't think of another one that where it has uses for both. I mean, it's of course a hugely important industrial commodity that's getting more and more important as the years go by, but it also has an investment kicker as well. And of course, when silver prices do start to rise, as they have in the past, we've had big rallies. The investment demand always kicks in big time, and sooner or later, rather within days or weeks, all the suppliers of silver are out of metal for weeks or months on end. So it's one of those commodities where, you know, once the price starts to rise, you're going to see commercial demand overwhelmed by I would say investment demand.
What is the gold fix and the silver fix, and what do they do?
Well, there are, I don't know, 8 or 9 or 10 of the bullion banks in the world. In London, they get on the phone or on the computer to each other every day and look at their buy and sell lists, and they match up the prices. And then they set a price for that particular moment, and everybody adjusts their books accordingly. The silver fix is at noon in London, and there's 2 gold fixes, one at 10:30 in London, the other one's at 3 o'clock in the afternoon. And the thing about the fixes is, of course, they're as ancient as the hills. I don't see any fixes for rubber or tin or aluminum or cocoa. Only gold and silver, because these are the 2 monetary metals, and when they fix the price, they're the fixes in sort of thing, because as most listeners are more than aware, the prices are completely managed, and the fixes are just another way that they do that.
Is that where that saying came from, the fix is in?
No, I don't think that's not the way it started back in the early 1900s when the world was still on a gold standard. When they did this because they thought it was necessary, but it's certainly come as a term now that when you hear the word silver and gold fix, everybody rolls their eyes in the back of their head and knows perfectly well that the fix is certainly in. So the meaning of the word has certainly changed in the last 10 years.
Wasn't there a recent settlement of manipulation charges on the COMEX gold and silver futures market?
Yeah, I think there was a trader convicted of spoofing and banging the fixes, and basically doing everything that the bullion banks are doing, and he was charged and convicted and no longer can trade. And Deutsche Bank has already said that they were manipulating the markets, and they've been charged and they were fined. But it hasn't stopped the price management scheme, because J.P. Morgan is at the center of it. And in all these lawsuits flying around, I don't see the name J.P. Morgan in there anywhere. And these lawsuits are wonderful, but they still haven't stopped the price management scheme, although they certainly are a shot across the bow to these guys.
Now, of course, you're using management, but would other people just say that gold and silver is still being manipulated?
Well, yeah, they're still, absolutely. The prices are being managed, and when you manage the prices of just not only gold and silver, but as I said in Vancouver a couple of weeks ago, you know, they have to manage platinum and palladium, because you can't have roaring platinum and palladium prices with gold and silver just sitting there. And of course, when you're managing the precious metals prices, you can easily control the commodity price, all commodity price. I don't care whether it's wheat or tin or rubber or cocoa. Let's put it this way: if gold was sitting at, let's say, $3,000 an ounce, I guarantee you the price of oil wouldn't be $48 right now, or the price of wheat $8 a bushel. Everything would rise, because they've been suppressing the commodity prices, gold and silver in particular, for more than 2 generations now. It has suppressed all commodity prices. So, yeah, the gold and silver fix is still in, and as long as they can manage to keep it on, they're going to keep it on.
Palladium's hit a record high. Is this all part of the same scheme?
Well, palladium hit a record high, and that was because there was, as Ted Butler told me on the phone the other day, there's some sort of short squeeze going on in palladium right now. And so that's the reason the price is high. But if we had a short squeeze where nobody came in to cap the rallies, we'd see all precious metals prices blasting higher, and palladium would even be much higher than it is because it's being managed as well. That rally is being controlled, but there's no question about it. It is a short covering rally of some kind.
Would people be confident if they were trading that, or should they avoid it?
Avoid it at all costs. It's such a tiny market. Unless you're a specialist, a user of this metal, or a trader of some experience, unless you want to go down and buy a 1-ounce platinum or palladium coin, those are two markets that the average investor should stay miles away from.
Is the commitment of traders a good indicator for the silver and gold markets?
Well, it certainly is, and it's receiving more and more attention all the time. I know that silver analyst Ted Butler, whose work I followed closely for the last 15 years, has used it as a guidepost as to what the bullion banks and the big traders are doing in the precious metals market, and he's been doing this, using it now for, like I said, 15 or 20 years, ever since it came out, and I think it was in the early 70s. And now you see every commentator in the world discussing it, mentioning, talking about it, just like the question you asked me right now. The positions of the big 8 traders have to be spelled out once per week by law, and you can just look at the numbers and you can see who's long and who's short, and it's always the big commercial banks that are short against every other trader in the world. That's just the way it's been for the last 45 or 50 years.
Is there currently a shortage of silver?
No, I don't think so. There's certainly more than enough to go around, but that would change instantly the moment that the price started to rise, because all of a sudden investment demand would kick in, and within days or weeks, you would be back in the position we were back several times, 3 or 4 or 5 years ago when the silver price took off. We'd be back in a situation where dealers and bullion dealers would be in a situation where they'd be waiting weeks or months for products because there just isn't any there. And on top of that, once there becomes a shortage in physical silver, then the users themselves, the people who use this stuff in their products, would start jumping in there and demanding physical as well. So I just can't imagine how high the price of silver would go with both the commercials and the investors vying for the same skinny amount of metal.
Silver, of course, is an industrial metal. It's used in computers, and now it's being used a lot for solar. Would that make a big difference in the demand for silver and its price? Solar itself.
It should. That's the key thing. It should make a difference in the price, but as long as it's being controlled, the supply and demand fundamentals matter not. Photography disappeared off the face of the earth, or at least the kind that we used to know. And that was a huge user of silver. That vanished, and now we have solar cells to take its place, but even that's already eclipsed the use by film. And we have more users of silver than ever before in the history of the world, and demand keeps climbing year after year after year, but it's having no effect on the price. So one of these days it will, but it just doesn't happen to be today.
Is silver a byproduct of other mines, or are there just pure silver mines?
Well, most of it is byproduct from copper, zinc, lead, and gold mining. I would say, 65 to 70%, maybe more. There are a lot of mines out there that, they mine silver exclusively, but most of them, even those silver mines that consider themselves pure, have huge byproduct credits of lead and zinc and copper and a little bit of gold as well. So is there a real pure silver mine where they have no byproduct at all? There's no such animal, but there are mines out there that primarily produce silver. And the universe of silver miners is pretty small, a couple of dozen at most.
Geopolitics, does that play a big role in silver mining?
From a mining standpoint, is that the question you're talking about?
Yes.
Okay, well, sure. There's our safe jurisdictions, and there's countries that aren't safe. The extreme example for me would be Pan American Silver back in the year 2000, 2001, when their Dukat mine in Russia got stolen out from underneath them by the oligarchs. And there are other countries in the world where, you wouldn't want to have a mine because the politics are just so bad. Africa comes up. Certain countries in Central America, but there are safe jurisdictions that promote mining. Mexico is one, Canada is another, Australia, Peru, Chile. Most Central American countries that are progressive, promote mining in one form or another. So there's some jurisdictions that investors should avoid, but most of them are pretty well known.
What price will silver need to reach to bring more mines online?
Well, that's a very good question for which I don't have an answer. It all depends on the grade of the ore in the ore body itself, and how much byproduct credit they're going to get out of it, because some mines may require only $25 an ounce, but there's maybe some deposits out there very large but very low grade that may require $50 or $60 an ounce before it becomes profitable to turn the ore body into a working mine. So it all depends on the ore body itself, but I would think a price reasonably substantially higher than it is now, like double, would make a difference. But the ore bodies out there for silver are getting fewer and fewer, at least the large ones, and all we're seeing now for silver, almost like gold, there's almost no big mines being discovered, because the earth is, the world is getting pretty close to being mined out of everything that's easy and cheap.
We'll have more with gold and silver expert Ed Steer next on This Week in Money.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
You're listening to This Week in Money. We're speaking with Ed Steer, the founder of EdSteerGoldandSilver.com. He's speaking to us from Edmonton. Ed, when people are looking at investments, how important is it to have gold and silver in your portfolio?
Well, I've been all in my investment portfolio in precious metals. I've been 100% all in for at least 10 years now, and I wouldn't recommend that to anybody in their right mind. My suggestion, which is a suggestion to most people, is like 10 or 20%. And if you're really aggressive and you understand the situation and your risk tolerance is high, you can go up to 50%. But it's not a strategy I would recommend for most investors. I would suggest they buy, 200 or 300 ounces of physical silver and, buy half a dozen different mining companies, salt that away and forget they got it. But I wouldn't get too stupid about it.
Is a drop in the U.S. dollar needed for gold and silver to take off?
Absolutely not. The dollar has absolutely nothing to do with this. It's the short positions of J.P. Morgan, Scotiabank, and the other bullion banks that determines the price of the precious metals. The dollar could go up, the dollar could go down, but until they stop sitting on the price in the COMEX, the price isn't going to do anything regardless of what the dollar does. Now, it may react to the dollar, but it doesn't need higher or lower dollar prices for it to take off. It just needs J.P. Morgan to get out of town.
Do you prefer precious metal stocks or bullion?
Well, I eat my own cooking. I have both. I have a position in physical, and I have a position in the mining shares. So I have both. I like both, and for obvious for diversity's sake, I have both bullion and the stocks.
Cryptocurrencies are currently in a roaring bull market. Is gold and silver likely to see the same kind of market anytime soon?
Well, that's the reason that cryptocurrencies are doing so well is there's no way to short them in the COMEX futures market. I'm sure if there was a way that the price could be driven lower, that the powers that be would be happy to do that. I'm sure if they set up a ability to trade it on the COMEX futures market in New York, you'd see the price crater in a real hurry. So, it's a fad. I wouldn't put any money into it, but, I'm not really the right person to ask about something like this, but to me, it's a fad, and one of these days, gold and silver will enjoy the same boom, and like I said, that will happen the moment that the bullion banks decide to step away from the market in New York.
Is that what would be needed to trigger a big run on silver?
Well, yeah. As soon as J.P. Morgan stops shorting, if they don't short the next rally, then I would say the silver bull market will last a very brief length of time. Like I'm talking about the price, it will rocket. It will take off because the short position, once it starts to get covered, it won't take very long for it to happen. But the after effects of that, with people jumping in buying gold and silver and all the other precious metals, that will last a long time, and we're going to see a feeding frenzy one of these days. I just don't know which day that is.
Now, back in the 70s, we saw the Hunt brothers try to corner the silver market. Would that be possible today?
Well, only if you're a bullion bank could you get away with that. And as Ted Butler has said and pointed out over the last 5 or 6 years, ever since we had the drive-by shooting in silver on May 1st, 2011, J.P. Morgan has been gobbling up every single solitary ounce of physical silver they can get their hands on, whether it's taking COMEX deliveries or skimming off the SLV ETF, for which they are custodian, or buying silver eagles or silver maple leafs or whatever is necessary. They have got 110 million ounces on the COMEX right now and hold over 50% of all the COMEX silver inventory that's available. And Ted figures they hold at least another 500 million ounces they got stashed away someplace else. So not only is J.P. Morgan controlling the price of the downside, they are also using that opportunity to skim physical metal off at a record rate. So are you asking whether or not this could be done again like the Hunt brothers did? Well, it's already happened, and J.P. Morgan is the new Hunt brothers.
It seems you keep mentioning J.P. Morgan over and over again. Obviously, they're in the manipulation business. Why hasn't anything been done about it?
Well, but J.P. Morgan basically, as Ted says, runs the U.S. government, and the CFTC does what it's told. When Bear Stearns got taken over by J.P. Morgan back in 2008, they took over all the Bear Stearns short positions. That's why they didn't go under like Lehman Brothers did, because if Bear Stearns had been liquidated, they would have been forced to go into the market and cover all the short positions that Bear Stearns was holding, and that would have driven the silver price to some rather large 3-digit number. So Jamie took it over, got a get out of jail free card in the process, and they've been using this to manipulate the price and collect as much silver as they can get. And one of these days, when they figure they got enough, they're going to let the price go. And like I said a couple of times during this interview, we don't know what that day is going to be, but it is coming.
The GATA, the Gold Antitrust Action Committee, also known as GATA, what exactly does it do?
Well, back in 1999, Chris Powell and Bill Murphy got together and decided that, it was obvious that the price of gold was being managed. And they decided that, naively enough, that if they put a few dollars together and got a few people and wrote a few letters, that they could end this thing in Washington. And they jumped through all kinds of hoops in Washington to get this thing to happen. And it was after a year or so they began to realize that they're not just up against some bullion banks trying to make a few bucks on the COMEX. They're up against all the money and all the power in the world that have a vested interest in keeping the precious metals price suppressed, so that the paper currency system and the paper markets, such as the stock markets and the bond markets, people would be investing in that and their products rather than investing in hard assets. And this has been going on now for, it's always been a fight between the banks and the working class people in the mining. And all you have to do is go back and look at the movie The Wizard of Oz, which is a parody on that situation. So GATA's been fighting, came along midstream in 1999, and what we discovered over the last 20 years is that we're up against all the money and all the power in the world. And one of those money powers is J.P. Morgan's Chase, and the other one is our beloved Canada Scotiabank right here in Canada, as they hold a huge short position in silver as well.
Is it frustrating when you run up against things like that, or is it a case of a good fight is worth battling?
Well, it's a combination of both, actually. It is a fight worth fighting. Okay, there's no question about it. It's been going on for a very long time. But on the other hand, I started this back in 2000, and it's now year 2007. So I've been at this for 17 years. It's consumed a large portion of my life. Ted Butler's been at it for more than 30 years. So it's frustrating and rewarding, but sooner or later the end will come. And I just hope that I live long enough to see that, along with a lot of other of your listeners out there who've been through the ringer on this thing for the last decade or so.
Is there anything in particular that your organization is doing right now?
Well, no. Basically, every time we get the opportunity, we're petitioning the lawmakers in Washington, D.C., and I know Chris puts out his GATA dispatches. He speaks at conferences all over the world. I know he's going to Singapore and Hong Kong again, and he's also been in London and in Europe. So every chance he gets the opportunity to go out and give GATA's message, like he did in Vancouver 2 weeks ago, he goes out there and preaches it to anybody who's prepared to listen. And, of course, now that we have the Internet and YouTube, anybody can access those speeches whenever they want. So GATA's been at this for a long time, and like I said, Chris Powell and Bill Murphy are out there pounding the pavement whenever they get the chance, and like I'm doing right now here with you.
Is it frustrating when you have to you just get the ear of a minister or a secretary, and then the government changes and you have to start talking to new people all over again?
Well, I'm not the one that talks to the government. That's mostly Chris and Bill that do that. So, and I'm from Canada. They're from the States, and because the price manipulation is in the United States, centered out of New York and Washington, that's where you would go for ground zero in this thing. So they just keep, as Winston Churchill, they just keep buggering on.
Where can people find out more about the GATA and your newsletter?
Well, yeah, you can go to the GATA website, which is gata.org, gata.org, or you can go to my website, which is edsteergoldandsilver.com, and you can learn more there. I know GATA has his daily dispatches. You can sign up for that for free, and of course, they're always looking for donations as well, and any and all would be gratefully received. I have a subscription-based website, and my fee on that is $100 US per year for 200 plus columns a year.
Ed, thank you so much for being on This Week in Money.
Well, thanks for having me.
My guest has been Ed Steer, founder of EdSteerGoldandSilver.com. He's also a director of GATA, also known as GATA, the Gold Antitrust Action Committee. Coming up, auto expert Wolf Richter next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
I'm Brian Fowler, President of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Wolf Richter. He's the founder of WolfStreet.com. He's speaking to us from San Francisco. Wolf, welcome to This Week in Money.
Thank you for having me on your show, Jim.
Can you tell us a little bit about WolfStreet.com first?
That's an economics and finance website that I started a few years ago. We get close to 1 million page views a month, so we're starting to be pretty popular here. We focus strictly on finance and economics. We stay out of politics. We stay out of particularly partisan politics, so we don't get involved in that at all. And we particularly focus on cars, on the car industry, on housing, on what central banks are doing, and housing that includes Canada. So we do have a pretty good coverage of the Canadian housing market, but more of it is really in the United States, and all kinds of other economic and financial things that come up.
Wolf, now we're going to talk mostly about the U.S. auto market, and we all know that Canada so often follows trends in the States. What is Carmageddon?
Well, Carmageddon was a huge traffic jam in L.A. a few years ago when they closed one of the freeways down there, and I have since recoined that term to signify what's going on in the U.S. auto industry. And I started getting worried about the industry early last year. I've been seeing some buildups of excesses. The industry is very cyclical. I used to work in it for a decade, and I know that. So there are up cycles that are long, and they're very good, and then there are down cycles that can be very brutal. And so the turning points are the things that I want to identify, and I started looking at it last year, and it turned out I was correct. It was a turning point. This year, sales are going down for all kinds of reasons. And despite the efforts by automakers to keep them at least level. And so we're looking at what's called a car recession. And given the amount of debt involved on the consumer side, I think this is going to be a major problem for the U.S. economy. The auto industry in the United States is sort of like an octopus. It goes into every direction. So you have railroads involved that ship these cars from the plants and from Canada and from ports of entry to the different cities around the country. So railroad traffic for cars is down. You have finance and insurance involved. There's about $1.2 trillion in auto loans out there. So that's a lot of it is securitized. So Wall Street has a big chunk of that. You have the manufacturing side of it. You have the retail side. There's the used car side. So this is and then all the secondary industry that supported the components makers, the sandwich shops near the dealerships. I mean, it goes across the spectrum. So the auto industry in the United States is big. Auto retail sales are 21% of total retail sales in the United States. So they really weigh pretty heavily on the scale. So I mean, if you want to watch one industry in the United States, that will be probably one to watch. I mean, finance in general is huge too in the United States. Not quite as big, but it doesn't have that many employees. It doesn't have that much impact on the real economy. The auto industry is just all in the real economy. It's manufacturing, it's retail, it's wholesale, it's transportation, it's trucking, railroads. It goes across the spectrum. So this is a really important thing to keep in front of us.
If the auto industry goes sideways, do you expect the U.S. and Canadian governments to bail them out again?
If it collapses for some reason, I don't see that. I don't see a collapse. But if it collapses like it did during the financial crisis, there may well be another bailout. During the financial crisis, actually going into the financial crisis, the U.S. automakers were already in terrible shape. They had huge inventories, they had inefficient manufacturing processes. They had all kinds of plants that they couldn't shut down for various reasons. That needed to be shut down. So they were, and particularly GM, Ford less so, but particularly GM and Chrysler, they were in really bad shape going into it. And then when the financial crisis happened, and Hank Paulson, the Secretary of Treasury, walked up to the Congress and said, "Look, guys, the world is ending. I need unlimited authority to bail out the banks." that's when the financial crisis became an economic crisis because everybody got scared and nobody bought anything anymore, and sales just collapsed. Just totally collapsed. They went from 16, 17 million annual rate before that happened to like 9 million. I mean, it dropped in half, and the entire industry there's this big vacuum, and it just collapsed. GM went bankrupt, Chrysler went bankrupt. Ford just kind of managed to avoid it by having borrowed a huge amount of money right beforehand, so they were pretty liquid. And so this was an extraordinary event that I don't see happening again. I do see a tough time for the automakers in the United States, but I don't see a crisis of that type.
Is unsold inventory growing for all the automakers?
Yeah, and when inventory, I mean, we're starting to have the same problems we had during the financial crisis, and inventory is one of them. Inventory now is at the highest level since 2009, and this is new car inventories on dealer lots. So these are cars that have been shipped to dealers and that dealers own and that they're trying to sell to their customers. For GM, that's 101 days. That's another record since the financial crisis. This is the kind of inventory that GM had when it collapsed. And so now what they're doing is they're selectively shutting some plants this summer. They're always shutting some plants down over the summer. Now they're extending those shutdowns. There's some layoffs involved. They shut some plants entirely. So they're trying to trim down the supply side a little bit. At the same time, they need to keep the plants running that they have, and so they keep cranking out the cars and they can't sell them, and so they try to throw huge incentives on the cars. There's some pickups. I don't know if you have that in Canada, but some pickups down here come with $15,000 in incentives. $12,000 is fairly common. $10,000 is almost standard in some of these trucks. For cars, it's less than that. The average per new vehicle sold of incentives is over $3,000 in May. It's a record. I mean, every month this year has been a record for that particular month. So, manufacturers are trying to cutting prices via these incentives, and it still hasn't moved the volume. I mean, that's the thing. Once you cut prices like that, you give these huge incentives and you advertise like a maniac, and volume still drops, you have a serious problem.
Will Carmageddon see the demise of a number of new and used car dealers, and are the manufacturers safe?
I imagine that some of the new car dealers may be impacted. New car dealers also sell used cars, and used cars are more profitable, and used cars are hot right now. So if you're a new car dealer that doesn't have a strong presence in the used car field, you may be in trouble. But in terms of just making money, it's in used cars, and we have in the United States, we have a huge supply of used cars, of auction cars. Coming in. They're coming from the rental car companies that are trying to trim their fleets. They're coming from these lease turn-ins. Leases have been a huge thing over the past few years. These are 2 or 3 year leases. The customers are turning in their vehicles now, and these are just enormous numbers, by the millions. And they're coming through the auction. Dealers buy them. Their prices at the wholesale level have dropped, so dealers can buy them for less. We just got the inflation figures yesterday, and on the retail level, prices have also dropped, but not as much. So the profit margin for dealers has gone up a little bit. Their wholesale price means their cost is going. According to the NADA, the wholesale cost for dealers now is down like 13% on average from the peak, whereas on the retail side, the retail prices are down only like 5%. So, and they're hot. I mean, we're almost certain going to have a record year for used vehicles in the United States. And we sell about 41 million used vehicles, so it's actually a much larger market in terms of units than new vehicles. We sell, if you're lucky this year, we might sell 16.5 million. Last year, we sold 17.4 million new vehicles. So that compares to 41 million used. So on the dealer side, I'm not too worried. They're going to make this up with used vehicles. Used vehicles are hot, and the profit margins are good, so they're pretty sound. the manufacturers have had 7 years of enormous profitable sales since the financial crisis. It's been a boom in the United States in vehicle sales, so they're sitting on a lot of cash. So I'm not too worried at this point that they're getting into really serious financial trouble. Also, GM sells more cars in China than it sells in the United States, so they really have diversified globally. And, when we bailed out GM, meaning bailout is to say, bailed it out of bankruptcy, the American taxpayer extended some debtor in possession loan to GM to get it out of bankruptcy, and that money then went to investments in China, and they got really big in China. I don't know if that's good for us or not, but that's what they did. So, they're going to be around. Ford too. I'm worried about Chrysler. Fiat Chrysler is not doing well in the United States. They've got some management issues, got some other issues. So if any of the three big American manufacturers get in trouble, I think it would be Fiat Chrysler. They've been out there trying to get one of the big car makers to buy them, and none of them will bite. Nobody wants Fiat Chrysler. So, so they're out there on their own. I don't think they will get into very serious trouble, but if there's one to watch, that would be the one, I think.
Do American luxury brands like Cadillac offer significant incentives that are not publicized or advertised?
Yeah, incentives in general are not advertised. You can get the data on the internet. It's not a secret, but sometimes they're advertised, but a lot of times they're not. In part because dealers negotiate the pricing with the customer, and so there's not really a standard price. So you don't always see the incentives, and a lot of times these incentives are not in form of rebate checks, but in form of dealer incentives. That could be volume incentives. It could be other incentives, that don't directly flow to the customer, that the dealer has the discretion to deal with as they please. So yeah, but that's been going on for forever. It's always, incentives used to be a secret. When I was in the business, they were essentially a secret, and there was no internet back then, so you couldn't find out unless they had rebates. Official rebate checks. Yeah, but when it was just an incentive by the manufacturer to the dealer, that was not known to the public, and it was up to the dealer to advertise these units at a really aggressive price, and that price was made possible by these incentives. Now, you got to remember, new car dealers in the United States, especially GM, Ford, Chrysler, their profit margins on new cars are pretty thin. So when they cut 10% off the sticker price, they've given away all of their profit margin and more. So in order for them to cut 10% off the sticker, and still make a little bit of money, they need to have a major incentive from the manufacturer to do that. And some of the luxury brands have much bigger profit margins, and pickup trucks have pretty hefty profit margins, and SUVs, smaller cars have just paper thin profit margins. So if it's just the dealer profit margin that can be given away, the discounts aren't going to be very big. So anytime you're looking at a $15,000 off retail, it means that there's a huge incentive from the manufacturer behind it, even if you can't see it.
For American brands, what's the dealer markup percentage on economy cars versus luxury sport utility vehicles?
Well, an economy car, it can be just a few $100. It's a few percentage points. It's when I was in the business, it started shrinking, and it continued shrinking. For automakers, we had some numbers coming out from Ford a few months ago when they were talking about shifting production to Mexico, and they only make like $800 on some of their smaller cars in profit, and the dealer doesn't make that much. So it's really thin. These small cars are incredibly competitive in the United States. People are not really fond of buying them, so they have to be priced competitively. And so dealers really aren't so excited about selling them. Trucks is a completely different story. I mean, trucks are cheaper to build. Actually, the cost for the manufacturer is lower, and they get a much higher profit margin. And the retail prices on a truck, I mean, looking at $40,000-$50,000. On a pickup truck, you can get SUVs for $60,000-$70,000. The mechanicals are not that expensive, and they've got nice interiors and stuff, but it doesn't cost that much to make. So the profit margins are just incredibly fat on these pickups and SUVs, and there's a lot of room to cut. So you can give big incentives on them, and it just depends. But $12,000-$15,000 profit margins from the manufacturing side is not uncommon. And on the dealers, it's several $1,000s.
Economically, is somebody better off to buy a 1-year-old car or buy a new car?
Yeah, if you intend to keep the car until the wheels fall off, economically speaking, there may be an incentive to buy an economic incentive to buy a new car, because you know what you get. When you buy a used car, you don't really know what the car has been through, even though you can assume it's in pretty decent shape, but you don't really know. But for most people, economically speaking, buying a recent model used car is a far better option, just in terms of money. And so you can buy a 2-year-old used car that might cost close to half what an equivalent new car will cost. And it might not last quite as long, but you paid a whole lot less. Your insurance is less, and your warranty, it's going to run out. It's still in the warranty, but it's going to run out sooner. So if anything major happens, you're going to be on the hook a little bit sooner. But knock on wood, you're going to have good luck with that car. So, if you really, if money is something that's the primary factor, buying a new car is almost insane, because you drive it off the lot. As soon as it goes over the curb, it drops thousands of dollars in value. You haven't even really driven it down the block yet, and you're already in the hole. So used cars don't do that. They don't change the value hardly at all the first few months.
Are subprime car loans a big concern?
Oh man, yeah. This is one of the big issues we have right now. There are subprime car loans. Subprime means a loan where the credit rating of the buyer is as a FICO score of 620 or below. And a lot of people like that, and they need to drive a car just like anybody else, and I'm glad that they find a way to finance it. But there have been, since the financial crisis, there have been a number of financing firms that have sprung up, and some of them are fairly big now. One of them, Santander, is a division of the Spanish bank that has, a few years ago, got partially spun off via an IPO. They got very aggressive in subprime lending. And Santander especially, it turns out it only verified income on 8% of the loan applicants it has. So it's into subprime, and it doesn't verify income. I mean, these are liar loans. And now Fitch is just reporting that the batch of loans that was issued in 2015 and that has been securitized into subprime-backed securities that are sold as bonds, they're on track to have a net loss ratio of 15%. So that would be the worst on record for any securitized subprime loans in the auto sector. That would be worse than during the financial crisis. So we're looking at huge losses there. Part of the problem with the subprime loan is that people buy a car, they trade in something that they're upside down, and so that they're several $1,000s in negative equity in their trade. So that negative amount gets rolled into the loan. So now they're really upside down in the new vehicle they just bought. Then they can't make the payment any other way. They extend the loan terms sometimes to 84 months, and that's 7 years. So the first year or two, there's almost no principal amortization, and when they default, the losses are just huge for and the vehicle gets repossessed. There's no problem. They find the vehicle and they repossess it, they sell it at the auction. But what they can get for at the auction and what is remaining on the loan is just a huge difference. And that's where these net losses come from. We have $1.2 trillion in new vehicle loans out there. A big chunk of that is subprime, and a big chunk of that is now going bad. So it will hit the lenders, and that's already happening. Santander's stock is down over 50% last year and a half. It will hit to some extent the investors, but the lenders are reacting by tightening up the lending, and so that's strangling the sales efforts by the manufacturers. Now they have trouble selling to these subprime rated customers. And the subprime rated customers, they can still buy, they just can't buy a new car anymore. Now they have to buy some older used vehicle. And of course, once they default, it's really difficult for them to buy anything at all. They're going to have to buy a $1,000 car for cash probably. So this is something that the subprime end of it, and it will, it's going to hurt some of the smaller lenders to the point where they'll probably topple, but it won't topple the big ones. It won't topple Ally, which is one of the bigger ones, the former GE captive, which is now independent. It won't kill it, but it might hurt Santander pretty badly, but it will take out some of the smaller lenders. And JP Morgan down to subprime auto lending too, and big banks, but they really won't feel that. They'll have a few $1 billion in losses and at the most, and they'll go on. But the companies that have been really aggressive in this, you'll see some of them topple, and that won't impact the financial system. So I'm not too worried about financial system going down like it did when the subprime mortgages blew up. But it will rearrange the auto lending business, and it will cause a lot of damage to new vehicle sales.
Subprime auto loan backed securities, what are they, and can they be shorted?
They can be shorted by hedge funds. They can't be shorted by retail investors. It's like shorting mortgage-backed securities during the financial crisis. It took a semi-genius to figure out how to do that, and it required the cooperation of banks to do that. So the same thing here. So I don't know how you would go about shorting them as a retail customer of a brokerage firm. There probably is no particular way to short them. Also, that may not be the right thing to short, because a lot of these subprime-backed securities are actually, they're structured securities. So these auto loans, subprime auto loans, get packaged into bond-like structures, and there are different layers, different tranches, and there'll be one tranche that has the highest recovery rate, and there'll be a tranche at the other end that will take the first loss. So the top-rated branch, maybe AAA rated, will probably be in pretty decent shape. The bottom tranche that takes the first loss will likely get wiped out, but the lenders are required to hang on to some of these bottom tranches. So that's where the lenders are taking the losses. So if you wanted to short these subprime-backed securities, the subprime auto loan-backed securities, you would probably want to short some of the lenders that are most aggressive in it. And of course, with Santander, you already missed the train a little bit because the stock's already down over 50%. And I've been writing about them for a long time. That's a wreck there. And then there are others, the smaller ones that they're not publicly traded, so you can't really short them. There's private equity behind them, and so it's tough to make money on that end now. And it's very well known. So by now, I've been writing about it for a year. Right now, it's a big national issue. So the easy money the low-hanging fruit really has been taken on this stuff.
Who's been the big buyer of subprime auto loan-backed securities?
Yeah, these are institutional investors, and when Treasury securities have a yield that's, depending on what maturity you buy, that's somewhere close to zero, as it was a year ago, or at the long end, 2.5%, 3%. you have a pension fund that needs to earn 7% on average, to stay liquid, or, you have a bond fund that needs to earn in that neighborhood, you're going to chase after risk. You're going to chase yield, and you're going to riskier bonds. And so these subprime auto loan-backed securities have been largely bought by institutional investors, such as pension funds, such as bond funds, and hedge funds buy them occasionally, private equity funds. So these are not anything that you can buy from your retail broker. Now, these are institutional investors are investing other people's money, so they don't really care that much about what happens to these securities as long as the whole market moves with them. And so if a pension fund loses 5% in a year, but the entire market is down 10%, the pension fund feels pretty good. So, and they blame the market, and that's their goal. And they just want to be at the market or beat the market, and so they don't really worry about particular securities when they buy them. Now, these may come to haunt them, and especially if they bought some of the lower rated ones that take some of the first losses, but I doubt that they did. Most of the time they buy the higher rated ones, and there'll be some losses, but it won't be huge losses that they have to take on those.
Does the real estate market have an effect on auto sales?
That's a great question. There is one aspect of it that I think could have an impact. I don't know how well it has been documented. The Fed, especially William Dudley, the president of the New York Fed, has come out officially saying that homeowners should use their homes more as an ATM, draw money out of it. Home prices have surged in the United States, not as much as in Canada, but they're up a lot. So people have some equity built up in their homes, and everybody's encouraging these homeowners now to do what they did before the financial crisis, which is to take that equity out through refinancing or through home equity loans, etc., and to spend this money. And Americans are doing that. American homeowners are back into this business of taking money out of their homes and buying stuff with it. And part of what they can buy with it are cars. And we're seeing some of that, at least make down payments or buy the whole car with it. Car loans are very cheap, so I don't know that they will be switching a car loan to a home loan. I don't know what the financial differences would be. I think it would probably not be a good thing because a lot of the car loans are subsidized. And so right now you can still borrow at ludicrously low rates. It's a car loan is a 5 to 7 year arrangement, so the interest rate's a lot lower than you would get on your 30-year mortgage. So it probably doesn't make sense to do that. But if they want to pay cash for a car and draw that equity out of their house, people probably are tempted to do that. And I know their spending, consumer spending is propped up by this, and whether they're buying cars instead or not, I don't know. Because financing cars is really easy. Financing other consumer products that you have to buy with your credit cards is not easy. It's expensive. So people might do that. But also, people feel wealthy when they sit on a home that went from $500,000 to, $1 million in 5 years, and so they feel more confident, even if the job isn't that promising. And so they feel more confident, and confident people are spending more money. Now it's shifted, and so they're not buying more cars. So we're not seeing that this year. Year to date, new vehicle sales in the United States are down, down 2% from last year, and the decline has accelerated. So it doesn't look very promising despite all the incentives. So I don't know that consumers are actually doing this. Now, if the housing market were to take a serious hit in the United States, and if it's heading south, that would really hurt consumer confidence, and it will close off the ATM that the home has become, and it will probably impact car sales in a negative way much more than it does in a positive way on the way up.
Are auto sales the canary in the coal mine for the stock market?
Well, if you look at Tesla, the answer is no. Yeah, I mean, Tesla stock is just completely nuts. The company doesn't make enough cars to even be a rounding error in the United States. So in May, we sold 1.52 million cars in the United States, and Tesla sold 4,000. So it didn't even show up as a rounding error. So on that side, I mean, the stocks that are way up there in the irrational exuberance arena, they're I don't know what will take them down. Probably, something will take them down eventually, but not something having to do with the real economy. Now, Ford, GM, the component makers, some of the other companies, finance companies that are affiliated with the auto industry, they have taken a huge hit. Ford and GM, the stocks are down, and especially Ford has just gotten crushed. So, I mean, the stock market has responded by, the rental car companies. I mean, they have completely gotten crushed, and they're very important in the auto industry in the United States. The stock market has responded in the sector, but it has not really infected other parts of the stock market yet.
If someone is in the market for a new car, when are the largest manufacturer incentives and dealer motivations likely to happen?
Well, the manufacturer's incentives are, they're based on the inventory levels that manufacturers have and the planned production that they have, and so they see on their side what the problems are, and they try to incentivize vehicles to get them out. And from the dealer side, the end of the month is critical. So if you go buy a car and you go there at the end of the month, the dealer's desperate, and especially if you're willing to walk out, when you negotiate and you make that willingness clear, you can probably accomplish a miracle or two. The incentives are on right now, and they're not getting any less. I mean, May was just another record month. June is going to be just the same. So, incentive-wise, I think this is a great time to buy. And if you go in at the end of the month after a tough month, and you're there on the 29th or the 30th or something like that, and you're willing to stand up and walk out, I think you can make a great deal. Now, I do have to say, dealers like to make money. They have to pay their employees. The profit margins are thin. So I don't advocate beating up on the dealers, because they're really, on the new car side, they're really in a tough business. They're completely controlled by the manufacturer in so many ways. On the used car side and in parts and service, they have more leeway, but on the new car side, they're between a rock and a hard place.
When buying a new vehicle, are you likely to get a better price going through a salesperson, the leasing department, or directly through the sales manager?
Let's separate leases from buying. When you lease a car, and there are good reasons for leasing a car, but when you lease a car, you have no idea what you're paying. There's no purchase price. You're not buying the car, you're renting it. So there's some upfront money, and there's some monthly payments, and then there's the lease end value, and there's some other factors. If you lease a car for 2 years, after 2 years you walk out and you have no equity, you have nothing. So every dime that you spent, the upfront money, in every car payment, that's just a sheer expense. You didn't acquire any equity in the car. The car's gone. The car goes. There's a buyout option usually, and you can look at that. But if you let the car go back to the leasing company, you're just done. And with a new car, if you buy it, if you don't finance it for 7 years, if you finance it for 4 years, after 2 years you have equity built up in your car, and after 2 more years of making payments, it's yours, and you can drive it for another 6 years completely debt free, and it becomes the cheapest car you'll ever have. So if you intend to rotate out of a car every 2 years, it's probably not a bad idea to lease. If you really are cost conscious, and we used to love leases because that's where dealer makes the money, and when I was in the business, we absolutely loved leases. We could sell a car at retail price, and we would sell the car to the leasing company, and the leasing company leases it to the customer. So we would arrange the deal to a point where we would get retail price for it, and the customer was happy because the monthly payments were low, and the finance company was happy because it made a ton of profit. And then after 2 or 3 years, the customer didn't have a car, so, I mean, from that point of view, I think for dealers and for automakers and for finance companies, leases are great. For customers, it's kind of it's a toss-up, you have to look at the numbers, and you don't know the numbers behind the lease. You don't know, what you're really paying for. So on a new vehicle, when you actually buy it, I think you should always start out with a salesperson, and because they're more knowledgeable about the car. So if you're shopping for something, not 100% sure what you want, they can show you around. They should be knowledgeable about the inventory they have on the lot. You don't want to waste the sales manager's time, and they'll switch you to somebody that knows that. Sales manager doesn't even know where all these cars are. That's not their job. At some point, the sales manager will get involved anyway. When it comes to negotiating, the salesman will either go to the sales manager or the sales manager will come to you. And at some point, when you stand up and walk out, you might actually get to meet the sales manager because they'll come talk to you and they'll try to make you a deal. But I think to start out with, you want to stick with a person that really knows the inventory, that knows the cars, whose job it is to know these things, and who's willing to spend a few hours with you, and then you can move up the ladder from there.
What kind of research should you do on used vehicles before completing the purchase?
Well, you definitely should look at all the internet sites that have used car values, and they come in different categories. There's retail and there's wholesale value, there's trade-in value. You should be familiar with that. They require you to put in the condition of the car, so whether it's in good condition or excellent condition, how many miles it has, your zip code, so that they kind of know what the market dynamics are, and so forth. And you get a pretty good feel for what this car should sell for. So this is just a generic type of car. Once you pick out a car, you should do a like Carfax search or something, and a dealer will do that for you. You'll ask them for it, and they'll show it to you. To establish the previous ownership, you need to make sure when you buy from a legitimate dealer, these things are normally handled properly. If you buy a car on the street someplace, you really don't know what you're getting. But you need to make sure that the title is clear. That it doesn't have a salvage title that's been laundered. You can find that out through these title searches, and the dealer will do that for you. But if you buy a car from somebody on the parking lot, you have no clue. So I'd be really careful. You can't do enough research, to find out. And so, but a legit dealer, you negotiate the price, and they'll show you the title history. You're in pretty good shape, and you cannot look at an engine and determine today if it's in good shape or not. I mean, you open the hood and you always see a bunch of plastic cables and tubes. You don't even see the engine. And so if you jack up the car, I mean, if it's an older vehicle, you'll see the leaks, but an older vehicle will have leaks. That's normal. But it's really hard to do a mechanical inspection of a car very quickly, and even if you do a 100-point inspection, they're not going to find the one thing that's wrong with the car that's going to cost you a lot of money. But most customers, they buy a used car that's 2 years old and that was owned by a rental car company or is at least turned in. They get an average used car that will last 10 years without major problems. So if you go through the legitimate channels, I think you're in pretty good shape.
Are there honest car salespeople?
Sure. There are, somewhere. I think the car industry is probably more honest than, say, the banking industry and a lot of other industries, in part because it's so heavily regulated and in part because it's so easy to sue car dealers. They're under tremendous pressure, to be honest. I mean, the disclosures and all kinds of forms you have to sign. And so, every dealership will have procedures in place to keep their salesmen honest. That doesn't always happen, so you'll run into the two issues there, But comparatively speaking, I think I've seen much worse in other industries, and so given the fraud that we have in the banking system leading up to the financial crisis, in the mortgage industry and all those kind of things, I think car dealers come out fairly clean, in that respect. But the rule is you need to verify. If there's a promise, you need to get it in writing. If they say something happened that didn't happen, you need to verify that. You don't need to abdicate all of this, to the dealer. You just verify it.
Wolf, how can people find out more about wolfstreet.com?
Well, they can come to my site, wolfstreet.com, and it's right there. I try to write for everybody, so I'm trying to stay away from jargon and financial lingo. At the same time, the topics I cover are pretty complex, so it's not always an easy read. But I try to make it fun and interesting, and we have a vibrant commenter community. I have lots of times more than 100 comments on the articles. A lot of it is from very well-informed commenters that add a lot to the discussion, and I try to keep it polite and clean and nonpartisan. And it's a great place to learn a lot more about finance and economics.
Thanks a lot for being on This Week in Money.
Well, thank you very much.
We've been speaking with Wolf Richter, founder of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up the end of our show. We'd like to thank our guests, Ross Clark, Ed Steer, and Wolf Richter. Now, stand by for showcase updates featuring American Manganese President Larry Ray and Aben Resources CEO Jim Pettit. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. We're speaking with Larry Ray. He's the CEO and president of American Manganese. Welcome back to the show, Larry.
Glad to be here, Jim.
Your company just put out a news release on Thursday. What kind of news did you have?
We had a research update on the progress of our recycling opportunity. And I have to say that we're meeting all of our goals, and that everything is just moving straight through the chute. Now, that said and done, there's excellent results. We're getting up close to 100%, and all the leaching of all the cathode materials, which includes lithium, cobalt, nickel, manganese, and aluminum. So everything's moving in the right direction, and I couldn't be happier with what's happening. Now, you have to remember that we have filed the provisional patents for this process, and those provisional patents protect us from anybody infringing on those patents up to the time we file the final patent, and that's what this work is for. To make sure that we have everything included in that patent application that we require on this process. And that is going smoothly. But I just thought I'd mention that the patent pending is really covers you as well as the granting of the patent, as the patent does. So, that said and done, we take a look at the market today after a great release yesterday, although we closed up higher. Today, it seems like somebody was selling a lot of stock, and I have to look at some of the short players for that. But we traded 600,000 today down to 16. That's to me is something that we have to put up with in the market, but I don't see that as a long-term situation. And I think that everything that we got in the development chute will change the situation around on the positive side for the shareholders. Now, there's not much more I can say about the results. They speak for themselves. But the other thing that I'd like to bring everybody up to date on is we're doing a private placement. And, of course, the short players like to try to kill the companies raising any money because it kills companies and then they can feed on the corpse. And but we're about 50% done. We should be closing on close to 50% of that early in the week, maybe as early as Monday. And there's commitments out there for the balance, so I'm not concerned about that. Getting $500,000 in with our existing cash and with what's accumulated from the exercise of warrants and options pretty much takes us pretty close to what we need to get the patent filed. So just make it a lot easier when we get the other half, $500,000 in. So I just want people to know that the company's not in any peril, and that we're moving ahead the best we can, and we're moving through very bad markets for the technology stocks at the moment. But we're coming through that, and we will have our money, and our results just keep coming up roses. So I would say, look forward to further releases. There's a lot more work that's going on, and there's a lot more things that are happening behind the scenes that could percolate at any time. If something like that happens, we got some great things going on, but, whether they happen or not is, I don't have my crystal ball to tell you that, but the fact is, I couldn't be more relaxed and happier than everything that's happening with the company. I'm not happy with the price. Nobody is. But I'm happy with the progress we've made. I'm happy with the response I get from the shareholders. And I'm happy with the response I'm getting out there in the community. It's, I just go to bed. I don't have any worries about about our process or about what's happening in the market. I have an old saying, why worry about things? Worry is debilitating. And that's what it is. And I go to bed at night and I have a good solid sleep and get up in the morning and see what's happening in the market and what's going to develop during the day. So it's an exciting time. So do you have any questions, Jim?
Well, Larry, that's great news to hear. And again, maybe just refresh our listeners' memories about exactly what American Manganese is up to.
Well, American Manganese has taken a existing technology, which is a patented process that we have for treating very low grades of manganese economically. We're taking that patent and adapting it to a recycling program for cathode materials. And I'm glad you asked the question, because there's one thing that I wanted to mention is I think a lot of people, especially the mining industry, look at it and say, wow, anybody can go out there and recover that material with a hydrometallurgical process, right? But that's not quite true. There's been companies working on a hydrometallurgical process for 7, 8 to 10 years and have never reached the milestones that we have. So I just want them to know that, part of the reason that we don't get all the action that we'd like to see is a lot of people don't look below the first layer of skin and see that, hey, this company is out there. We know there's only one other patent application out there for recycling of batteries, and that came after ours. So, because we did a search and searched for that sort of thing before we ever filed for the provisional. So those are just things that, you jog your mind and let you know that maybe the shareholders would be interested in you sharing that information with.
Larry, can you tell us where American Manganese is traded and how they can get a hold of you?
American Manganese is traded on the TSX Venture Exchange under the symbol AMY. It's traded in the U.S. under the symbol AMYZF, and in Germany under the symbol Frankfurt under the symbol 2AM. The website is www.americanmanganeseinc.com, and I may be reached at lray, R-E-A-U-G-H, at amymn.com, or pick up the phone and give me a call anytime you feel like it at 778-574-4444.
Larry, thanks for the update.
Okay, thanks, Jim.
My guest has been Larry Ray, CEO and President of American Manganese. We were speaking on June 16th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. We're speaking with Jim Pettit. He's the CEO and President of Aben Resources. Welcome back to the show, Jim.
Thank you very much. Good to be here.
A news release has just come out from Aben. What does it tell us?
Well, Aben has just announced a financing for our work program this summer up in the Golden Triangle of British Columbia. The Forest Kerr property in particular. Financing's hard dollars or non-flow-through is 10 cents with a 15-cent warrant. And there's a flow-through component to it, which is 12.5 cents with a 15-cent component. We're going to raise up to 500,000 hard dollars and 750,000 flow-through. And I suspect it will be sold out very quickly.
Do you have any projects underway or about to start?
Well, our Forest Kerr project is virtually getting ready to go next week. I did wait until the last minute to raise funds because I had warrants that were being exercised for the last 2 months. So we brought in an extra $500,000 in warrants that were going to expire at the end of May. When that was done, then I now announced the financing. So financially we'll be in really good shape. Our budget to start with will be about $1.3 million, and we want to drill 2,000 to 2,500 meters. And there's a fair amount of flexibility because the drilling would start in August. The field work is starting Monday, and permitting should all be in place by then for the drilling program.
What exactly are you guys looking for?
Well, this is a significant gold project. This is elephant country up there. Where our property is situated about exactly halfway between the old Snip mine and the old Eskay Creek mine. The Forest Kerr property lies right on the Kerr Fault, which runs north-south. So it's a very long, almost 50-kilometer long regional fault that we now encompass just about the whole thing. And we look at it as a major driving force or engine for the whole region. And it is a region that has incredible grades. And it's not just limited to gold. There's a tremendous amount of silver in the area. Eskay Creek it mined about 160 million ounces of silver. And, the gold numbers were astronomical. And you've got Pretium is going into production any minute this summer. So they'll be pouring their first bars momentarily, and there's lots going on. There's probably 8 other companies all around us that are going to be working this summer.
Does it give you a lot of confidence then that you have so much history behind this area?
Oh, it does. This area was explored 30 some odd years ago initially, because of the discovery at Eskay Creek, which was, groundbreaking. It was probably the richest gold mine in the world. they were looking for at the time of EMS system, geologic system like Eskay Creeks, and now we've got a different style of geography or geology, which Pretium is showing everybody, so a little more structurally controlled rather than a VMS. So, there's a lot to be looked at or re-looked at. And on our property, we've got about 100 historic holes and up to 20,000 historic soil and rock samples. So we've compiled it into a regional database, and we've got some good areas, the best areas in our mind to go in and start with. I like the 4 best locations out of probably 30 that we can go in and work.
Do you have new technology that the old-time miners wouldn't have had access to that make you even more confident?
Well, a good understanding of structure is one thing, and that's just an advancement of, the geologic know-how. We're going up in the field right away with a structural geologist. It's a very complex area. Geophysics has come a long way. Even though, today it can be difficult because of the terrain. It's quite steep, etc. We've got a lot of, the soil sampling and that sort of thing. It is what it is. You've got a better ability to compile that data rather than on a property scale, on a regional scale.
What communities are around there, just so people can get a better geographic sense of where it is?
Stewart is straight south. So it's a real historic belt. To our north is Dease Lake. There's a highway runs straight up, to our east. In the last 10 years, there's been a lot of infrastructure put into the area. The road that comes, originally it was going into Eskay Creek, but it now is a road that takes you to what is now the major power plants in the area, the Runner River Power that are now powering the northwest quadrant of British Columbia. And the AltaGas, which built that, has left their huge camp facility in place, and it's capable of handling about 200 men. And so we can basically utilize that as a staging point. Or, as it's not a long distance, we can fly our crews in every day by helicopter, 10, 15-minute flight, and then they can stay in and it's not a lodge, but it's a huge ATCO trailer system. And at a reasonable price, $250 a day per man, food, accommodations, and all the first aid is there too. So it's probably as inexpensive, or the same price as putting up a 10-man camp up into the region.
How many people involved now, and if the project takes off, how many people involved then?
Well, we're starting this month with coming up with a 4-man crew, 2 geologists, 2 rock pickers. And they're basically going to be really going over the first areas that we want to drill, because those areas are associated with historic drilling that was really, really quite good, but very little follow-up. So they want to go in there and make sure that they can find the drill collars, that they can position the pads where they want them, that the drill's going to sit on. And then when you get drilling, then you've got the core handlers, drill crew. You're going to have up to 10 people.
Is there a lot of excitement in the industry generally in that area? And are people, I have to say, a little jealous that you might have found another mainstream gold find? Well,
yeah, there's a lot of interest in the area. There's talk that there'll be up to $100 million worth of work this summer. It's probably on par with what's going on in Quebec in the Windfall Lake area with Osisko and that, and all the juniors around them. It's a really good area play. Last year was definitely telling, because we announced that we had acquired the ground. We really weren't going to do any work, but the stock went from 7 cents to 35, and that was based on work going on around us. So, we haven't seen area plays like that for a long time, but the interest here is, it's justifiable. This is probably the most richly endowed gold country in the world.
Jim, where can people find you on the markets?
Well, our symbol is abn.v in Vancouver. we're located in Vancouver, TSX. OTC is ABNAF. Frankfurt is E2L2. They can contact me or Don Myers at 604-687-3376 or 1-800-567-8181.
Jim, thanks for the update.
You bet. Anytime.
We've been speaking with Jim Pettit. He's the president and CEO of Aben Resources. We were speaking on June 14th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.